Chapter 1, Introduction to Accounting Standards. Chapter Overview. In this chapter, we are going to study about introduction, objective and benefits of accounting standard setting process, list of accounting standard, need for convergence to global standards, international financial reporting standards, convergence to IFRS in India, concept of Indi IAS, then carve-outs and carve-ins, and roadmap for Indi accounting standards implementation. Introduction. Generally accepted accounting principles. Generally accepted accounting principle, also known as GAAP, refers to a common set of accepted accounting principles, standards, and procedures that reporting entity must follow when it prepares and presents its financial statement. GAAP is a combination of authoritative standards and the commonly accepted ways of recording and reporting accounting information. At international level, such authoritative standards are known as International Financial Reporting Standards at many places, and in India we have authoritative standards named as Accounting Standard and Indian Accounting Standard (INDAS). Accounting standards are written policy document issued by the government with the support of other regulatory bodies, that is Ministry of Corporate Affairs, issuing accounting standard for corporates in consultation with National Financial Reporting Authority, covering the following aspects of accounting transactions or events in the financial statement. First, recognition, measurement, presentation, and disclosure. The obtainable purpose of the standard setting bodies is to promote the dissemination of timely and useful financial information to investors and certain other stakeholders having an interest in the company's economic performance. Accounting standard reduces the accounting alternative in the preparation of financial statement within the bound of rationality, thereby ensuring comparability of financial statement of different enterprises. Accounting standards deals with the following aspects. First, recognition of events and transactions in the financial statement, measurement of these transactions and events, presentation of these transactions and events in the financial statement in a manner that is meaningful and understandable to the readers, and the disclosure relating to these transactions and events to enable the public at large and the stakeholders and the potential investor in particular to get an insight into what these financial statements are trying to reflect, and thereby facilitating them to take prudent and informed business decisions. Accounting standard deals with various aspects of accounting events. First, recognition of event and transaction. Second, measurement of transactions and events. Third, presentation of transaction and events. And fourth, disclosure requirements. The following are the benefits of accounting standards. First, standardization of alternative accounting treatments. Accounting standard reduce or eliminate to a reasonable extent any confusing variation in the accounting treatment and presentation of economic events while preparing financial statement. The standard policies are intended to reflect a consensus on accounting policies to be used in different identified area, that is inventory valuation, capitalization of cost, depreciation and amortization, etc. Since it is not possible to prescribe a single set of policy for any specific accounting area that would be appropriate for all enterprises, it is not enough to comply with the standard and state that they have been followed. In other words, one must also disclose the accounting policies used in preparation of financial statement. Refer to AS1, disclosure of accounting policy given in accounting prominence. For example, an enterprise should disclose which of the permit cost formula, FIFO, weighted average, etc. has been actually been used for ascertaining inventory cost. Requirements for additional disclosures. There are certain areas where information is not statutorily required to be disclosed. However, accounting standards may call for appropriate disclosures of accounting policies followed and other required information in the financial statement which would be helpful for reading readers to understand the accounting treatment done for various items in those financial statements. Comparability of financial statement. In addition to improve credibility of accounting data, standardization of accounting procedures improves comparability of financial statement. Both intra-enterprise and inter-enterprise, such as comparison, are very effective and most widely used tool for assessment of enterprise financial health and performance by users of financial statement for taking economic decisions, that is whether or not to invest, whether or not to lend, and so on. The intra-enterprise comparison involves comparison of financial statement of same enterprise over a number of years. The intra-enterprise comparison is possible if the enterprise uses same accounting policy every year drawing up its financial statement. The inter-enterprise comparison involves comparisons of financial statement of different enterprises for same accounting period. This is possible only when comparable enterprises use a similar accounting policy in preparation of respective financial statement. The disclosure of accounting policy allows a user to make appropriate adjustment while comparing the financial statement of comparable enterprises. Since accounting standards are principle-based, application of accounting standard become judgmental in case of complex business transaction. Accounting standards have to be read in line with the legal requirements, that is, in case of any conflict, statute would prevail over accounting standard. Another advantage of standardization is reduction of scope for creative accounting. The creative accounting refers to twist of accounting policies to produce financial statement favorable to a particular interest group. For example, it is possible to overstate profit and asset by capitalizing revenue expenditure or to understate them by writing off a capital expenditure against revenue of current accounting period. Such practices can be curbed only by framing policy for capitalization, particularly for the borderline cases where it is possible to have divergent views. The accounting standards provide adequate guidance in these regards. Standard setting process. The Institute of Chartered Accountants of India, being a premier accounting body in this country, took upon itself the leadership role by constituting the Accounting Standards Board in 1977. The ICAI has significant incentive for the issuance of accounting standard to ensure that the standard setting process is fully consultative and transparent. The ASB considered the international accounting standards, international financial reporting standards while framing accounting standards in India and tried to integrate them in the light of applicable laws, custom, usage, and business environment in the country. The composite of ASB includes representative of industry, association of industry, regulators, academicians, government department, etc. Although ASB is a body constituted by the Council of the ICAI, it is independent in the formulation of accounting standards. NFRA recommend these standards to MCA. MCA has the special spell out the accounting standard applicable for company in India. The standard setting process of ASB can briefly be outlined as follows. Identification of area. Identification of broad areas by ASB for formulation of AS. Constitution of study groups. Constitution of study groups by ASB to consider specific project and to prepare preliminary draft of the proposed accounting standards. The draft normally includes objective and scope of the standards, definition of the terms used in the standards, recognition and measurement principles wherever applicable, and presentation and disclosure requirements. Consideration of preliminary draft prepared by the study groups of ASB and revisions, if any, of the draft on the basis of deliberation. Preparation of draft and its circulation. Circulation of draft of accounting standards to the council members of the ICAI and specified outside bodies such as MCA, Security, SEBI, Controller and Auditor General of India, Central Board of Direct Taxes, Standing Conference of Public Enterprises, etc. for comments. Ascertainment of view of different body on draft. meeting with the representative of the specified outside bodies to ascertain their views on the draft of the proposed accounting standard. Finalization of exposure draft ED. Finalization of the exposure draft of the proposed accounting standard and its issuance, inviting public comments. Comments received on exposure draft. Consideration of comments received on the exposure draft and the finalization of the draft accounting standard by the ASB for submission to the Council of ICAI for its consideration and approval for issuance. Modification of draft. Consideration of the final draft of the proposed standard by the Council of ICAI, and if found necessary, modification of the draft in consultation with the ASB is done. Issue of AS. The accounting standards on the relevant subject is then issued by the ICAI for corporate entities. The accounting standards are issued by the Ministry of Corporate Affairs in consultation with NFRA. Earlier, ASB used to issue accounting standard interpretation which addressed questions that arise in course of application of standard. These were therefore issued after issuance of the relevant standard. Authority of the ASI was same as that of the AS to which it relates. However, after notification of accounting standard by the central government for the companies where the conscience proportion of ASI was merged as explanation to the relevant paragraph of the accounting standard, the Council of ICA also decided to merge the conscience proportion of ASI as explanation to relevant paragraph of the AS issued by them. This initiative was taken by the Council of the ICAI to harmonize both the set of standards, that is AS issued by the ICAI for non-corporate and AS notified by the MCA for corporates. It may be noted that as per Section 133 of the Companies Act 2013, the central government may prescribe the standards of accounting or any addendum thereto, as recommended by ICAI, constituted under Section 3 of the Chartered Accountant Act 1949, in consultation with and after examination of recommendation made by NFRA. How many accounting standards? The Institute of Chartered Accountants of India has so far issued 29 accounting standards. However, Accounting Standard 6 on depreciation accounting has been withdrawn on revision of Accounting Standard 10 property, plant and equipment, and Accounting Standard 8 on accounting for research and development has been withdrawn consequent to the issuance of Accounting Standard 26 on intangible assets. Thus, effectively, there are 27 accounting standards at present. The accounting standards issued by the Accounting Standard Board establish standards which have to be compiled by the business entities so that the financial statements are prepared in accordance with GAAP. In recent time, there are various development in the global accounting standards which have taken place. In India, AS have become mandatory for certain class of company as per the MCA roadmap. AS being the guideline to prepare financial statement have to keep pace with these changes in global accounting scenarios. Number of fundamental changes have been made in these areas as so as to be globally aligned as far as possible. MCA with notification date 30th March 2016 announced companies amendment rule 2016. These rules were surpassed by the Company Rule 2021, which were notified by the MC on 23rd June 2021. Various accounting standard, that is Accounting Standard 2, Accounting Standard 4, AS10, AS13, AS14, AS21, AS29 have been revised to make them in line with corresponding NDAs to the extent possible. The following is the list of accounting standards with their respective date and of applicability. AS number 1, AS title, disclosure of accounting policy, date of applicability 1st April 1993. Accounting standard number 2, valuation of inventories, revised 1st April 1999. Accounting standard 3, cash flow statement, 1st April 2001. Accounting standard for contingencies and events occurring after the balance sheet date 1st April 1998. net profit or loss for period prior period items and changes in accounting policies, accounting standard number 5, 1st April 1996. Construction contracts, accounting standard number 7, 1st April 2002. Revenue recognition, accounting standard number 9, 1st April 1993. Accounting standard number 10, property, plant and equipment, revised 1st April 2016. Accounting standard number 11, the effect of change in foreign exchange rates, 1st April 2004. Accounting standard number 12, accounting for government grants, 1st April 1994. Accounting for investment, accounting standard number 13, revised 1st April 1995. Accounting for amalgamation, accounting standard number 14, 1st April 1995. Accounting standard number 15, employee benefits, 1st April 2006. Accounting standard number 16, borrowings, 1st April 2000. Accounting standard number 17, segment reporting, 1st April 2001. Accounting standard number 18, related party disclosures, 1st April 2001. Accounting standard number 19, leases, 1st April 2001. Accounting standard number 20, earning per share, 1st April 2001. Accounting standard number 21, consolidated financial statement, 1st April 2001. Accounting for taxes on income, 1st April 2006. Accounting standard number 23, accounting for investment in associates in consolidated financial statement, 1st April 2002. Accounting standard number 24, discontinuing operation, 1st April 2004. Accounting standard number 25, interim financial reporting, 1st April 2002. Accounting standard number 26, intangible assets, 1st April 2003. Accounting standard number 27, financial reporting of interest in joint venture, 1st April 2002. Accounting standard number 28, impairment of assets, 1st April 2008. Accounting standard number 29, provisions, contingent liabilities and contingent asset, 1st April 2004. Note: in the study material, accounting standards have not been discussed sequentially. Instead, the related accounting standards have been grouped and discussed in the ensuing chapter for ease of understanding. For example, the presentation and disclosure based accounting standard like accounting standard 1, 3, 17, 18, 20, 24, 25 have been grouped in one chapter. The chapter-wise grouping of accounting standards has been discussed in the study material as follows. Chapter 4, presentation and disclosures based accounting standards. Accounting standard number 1, disclosure of accounting policy. Accounting standard number 3, cash flow statement, 17 segment reporting, 18 related party disclosures, 20 earning per shares, 24 discontinuing operations, 25 interim financial reporting. Chapter 5, asset based accounting standards. Accounting standard number 2, valuation of inventories, 10 property plant and equipment, 13 accounting for investment, 16 borrowing costs, 19 leases, 26 intangible assets and 28 impairment of assets. Liabilities based accounting standard, chapter number 6, accounting standards number 15, employee benefits, and 29, provisions, contingent liabilities and contingent assets. Chapter 7, accounting standard based on item impacting financial statement for contingencies and event occurrence after the balance sheet date. 5, net profits or losses for the period prior period items and changes in accounting policies. 11, the effect of changes in foreign exchange rates. And 22, accounting for tax on income. Chapter 8, revenue based accounting standards. Accounting standard number 7, construction contracts, and 9, revenue recognition. Chapter 9, other accounting standards. 12, accounting for government grants. 14, accounting for amalgamation, excluding intercompany holdings. Chapter 10, accounting standard for consolidated financial statement. Accounting standard number 21, consolidated financial statement of single subsidiary, excluding problems involving acquisition of interest in subsidies at different dates, cross holding, disposal of a subsidiary, and foreign subsidiaries. Accounting standard number 23, accounting for investment in associates in consolidated financial statements, and 27, financial reporting of interest in joint venture. Status of accounting standards. It has already been mentioned that the accounting standards are developed by the ASB of the ICAI. The institute, not being a legislative body, can enforce compliance with its standards only by its members. Also, the standards cannot override law and local regulation. The accounting standards are nevertheless made mandatory from the date specified in the respective standards and are generally applicable to all enterprises, subject to certain exceptions. The implication of mandatory status of an accounting standard depends on whether the statute governing the enterprise concerned requires compliance with their accounting standards. The Companies Act had earlier notified 28 accounting standards and mandated the corporate entities to comply with the provisions stated therein. However, in 2016, the MCA withdrew Accounting Standard 6. Hence, there are only 27 notified accounting standards as per the Companies Rule 2021. Need for convergence towards global standard. The last decade has witnessed a sea change in the global economic scenario. The emergence of transnational corporations in search of money not only for fueling growth but to sustain ongoing activities has necessitated raising of capital from all parts of the world cutting across frontiers. Few key aspects which required the need for convergence are as under: raising funds from international market. Each country has its own set of rules and regulations for accounting and financial reporting. Therefore, when an enterprise decides to raise capital from the market other than the country in which it is located, the rules and regulations of that other country will apply, and this in turn will require that the enterprise is in a position to understand the difference between the rules governing financial reporting in the foreign country as compared to its own country of origin. Therefore, translation and reinstatement are of utmost importance in a world that is rapidly globalizing in all ways. Further, accounting standards and principles need to be robust so that the larger society develops degree of confidence in the financial statement which are put forward by organizations. Comparability of financial statement. International analysts and investors would like to compare financial statement based on similar accounting standards. This has led to the growing need for an internationally accepted set of accounting standards for cross-border filing. The harmonization of financial reporting about the world will help to raise confidence of investors generally in the information they are using to make their decision and assess their risk. Uniformity, comparability, etc. A strong need was felt by legislation to bring about uniformity, rationalization, comparability, transparency, and adaptability in financial statement. Having a multiplicity of types of accounting standards around the world is against the public interest. If accounting for the same event and information produce different reported numbers depending on the system of standards that are being used, then it is self-evident that accounting will be increasingly discredited in the eyes of those using the numbers. It creates confusion, encourages errors, and may facilitate fraud. The cure for this illness is to have a single set of global standards of highest quality set in the interest of public. Global standard facilitates cross-border flow of money, global listing in different stock market, and comparability of financial statement. Global investment. The convergence of financial reporting and accounting standard is a valuable process that contributes to the free flow of global investment and achieves substantial benefits for all capital market stakeholders. It improves the ability of investors to compare investments on a global basis and thus lower their risk of errors of judgment. It facilitates accounting and reporting for companies with global operations and eliminates some cost requirements like reinstatement of financial statement. It has the potential to create a new standard of accountability and greater transparency, provides value to all market participants, including regulators. It reduces operational challenges for firms and focuses their values and expertise around an increasing unified set of standards. It creates an unprecedented opportunity for setters and other stakeholders to improve the report modeling. For the companies with joint listing in both domestic and foreign country, the conversion is very much significant. International Accounting Standard Board IASB. With a view of achieving the objective of setting global standard, the London-based group, namely the International Accounting Standard Community, responsible for developing international accounting standard, was established in June 1973. It is presently known as International Accounting Standard Board. The IASC comprises the professional accountancy bodies of over 75 countries, including ICAI. Primarily, the IASC was established in the public interest to formulate and publish IASs to be followed in the preparation and presentation of financial statements. IAS were issued to promote acceptance and observance of IAS worldwide. The members of IASC undertook a responsibility to support the standards developed by IASC and to propagate those standards in their respective countries. Between 1973 and 2001, the IASC released IAS. Between 1997 and 1999, the IAS restructured their organization, which resulted in formation of IASB. These changes came into effect on 1st April 2001. Subsequently, IASB issued statement about current and future standards. IASB published its standards in a series of pronouncement called International Financial Reporting Standards. However, IASB has not rejected the standards issued by the IASC. Those pronouncements continue to be designed as international accounting standards. The standard issued by IASC till 31st March 2001 are known as IASs, and the standard issued by IASB since 1st April 2001 are known as IFRS. International Financial Reporting Standards as global standards. The term International Financial Reporting Standards comprises IFRS issued by IASB, IAS issued by IASC, interpretations issued by the Standard Interpretation Committee SIC, and interpretation issued by the IFRS Interpretations Committee of the IASB called IFRIC International Financial Reporting Standard Interpretation Committee. IFRS are considered as a principle-based set of standards. In fact, they establish broad rules rather than dictating specific treatment. Every major nation is moving towards adopting them to some extent. The large number of authorities permits public companies to use IFRS for stock exchange list proposes, and in addition, banks, insurance companies, stock exchange may use them for statutorily required reports. So over the next few years, number of companies will adopt the international standards. This requirement will affect thousands of enterprises, including their subsidiaries, equity investors, and joint venture partners. The increased use of IFRS is not limited to public company listing requirement or statutory reporting. Many lenders and regulatory and government bodies are looking for IFRS to fulfill local financial reporting obligations related to financing or licensing. Becoming IFRS compliant. Any country can become IFRS compliant either by adaptation process or by convergence process. Technique 1, adaptation process. Adaptation would mean that the country sets a specific timetable when a specific entity would be required to use IFRS as issued by the IASB. Convergence process. Convergence means that the country will develop high quality, compatible accounting standards, and there would be alignment of the standards of different standards setter with a certain rate of compromise by adopting the requirement of standards either fully or partially. Indian AS are almost similar to IFRS but with few carves out so as to make them suitable for Indian environment. Convergence with IFRS will result in the following benefits: improves investors' confidence across the world with transparency and comparability, improves inter-unit, inter-firm, inter-industry comparison, group consolidation will be easy with same standard by all companies in group irrespective of their global location, acceptability of financial statements by stock exchange across the globe which will facilitate list of Indian companies to international stock exchange. What are carve outs in Indias? The government of India, in consultation with the ICAI, decide to converge and not to adopt IFRS issued by the IASB. The decision of convergence rather than adaptation was taken after the detailed analysis of IFRS requirement and extensive discussion with various stakeholders. Accordingly, while formulating IND efforts have been made to keep these standards as far as possible in line with the corresponding and departures have been made where considered absolutely essential. These changes have been made considering various factors such as terminology difference. Various terminology related changes have been made to make it consistent with the terminologies used in law, that is statement of profit and loss in place of statement of comprehensive income and balance sheet in place of statement of financial position. Removal of option in accounting principle and practices. Removal of option in accounting principle and practices in India vis IFRS have been made to maintain consistency and comparability of financial statements to be prepared by following Indi AS. However, these changes will not result into carve-outs. Difference in economic environment. Certain changes have been made considering the economic environment of the country, which is different as compared to the economic environment presumed to be in existence by IFRS. These differences are due to differences in economic condition prevailing in India. These differences, which are in deviation to the accounting principle and practices stated in IFRS, are commonly known as carve-outs. Additionally, additional guidance given in Ind AS over and above what is given in if IFRS is termed as carve-in. Convergence to IFRS in India. In the scenario of globalization, India cannot isolate itself from the accounting development taking place worldwide. In India, so far as the ICAI, NFRA, and various regulatory such as SEBI and Reserve Bank of India are concerned, the aim is to comply with the IFRS to the extent possible with the objective formulate sound financial reporting standards for the purpose of preparing globally accepted financial statement. The ICAI, being a member of International Federation of Accountants (IFAC), considered the IFRS and tried to integrate them to the extent possible in the light of the laws, customs, practices, and business environment prevailing in India. Due to the recent stream of overseas acquisition by Indian companies, there is need for adaptation of high quality standards to convince foreign enterprise about the financial standing as also the disclosure and governance standards of India acquirers. In India, the ICI has worked towards convergence of global accounting standards by considering the application of IFRS in India corporate environment. Recognizing the growing need of fully convergence of the IndAS and with IFRS, ICI constituted a task force to examine various issues involved. Full convergence involves adaptation of IFRS in the same form as that issued by IASB. For convergence of Ind IAS with IFRS, the ASB in consultation with the MCA decides that there will be two separate set of accounting standard which first with Ind AS converged with the IFRS standards which are being converged by eliminating the difference of the Ind AS as which as IFRS and existing notified AS. What are Indian accounting standards? Ind AS are IFRS converged standards issued by the central government of India under the supervision and control of ASB of ICAI and in consultation with NFRA. NFRA recommends these standards to the MCA. MCA has to spell out the accounting standard applicable for company in India. Int years as are named and numbered in the in the same way as the corresponding IAS. However, for int years corresponding to IFRS, one need to add 100 to the IFRS number. That is, for IFRS 1 corresponding int years number is 101. History of IFRS converged Indian accounting standards Ind AS. First step towards IFRS. The ICAI, being the accounting standard setting body in India way back in 2006, initiated the process of moving towards the IFRS issued by the IASB with a view to enhance acceptability and transparency of the financial information communicated by the Indian corporate through their financial statement. This move towards IFRS was subsequently accepted by the Government of India. Government of India commitment to IFRS converged in AS. As per the original roadmap for implementation of IFRS converged in AS issued by the Government of India, initially in AS were expected to be implemented from the year 2011. However, keeping in view the fact that certain issues, including tax issues, were still to be addressed, the Ministry of Corporate Affairs decided to postpone the date of implementation of Ind AS. In July 2014, the Finance Minister of India at that time, late Sri Arun Jaitley ji, in his budget speech announced an urgency to converge the existing accounting standards with the IFRS through adopting of the Ind AS by the Indian companies. Pursuant to the above announcement, various steps have been taken to facilitate the implementation of IFRS converged in AS. As moving in this direction, the MCA issued the Company Rule 2015 with notification date February 16, 2015, covering the revised roadmap of implementation of Ind AS for companies other than banking companies, insurance companies, NBFCs, and Ind AS. As per the notification, Ind AS converged with IFRS were required to be implemented on voluntary basis from 1st April 2015 and mandatorily from 1st April 2016. Separate roadmaps were prescribed for implementation of Ind AS to banking, insurance companies, and NBFCs. List of Indian accounting standard. The following is the list of notified Indian accounting standard with respect to IFRS and AS. Indian Accounting Standard 101, IFRS Accounting Standard 1, Title of Indian Accounting Standard or IFRS, First Time Adoption of Indian Accounting Standards, Indian Accounting Standards 102, IFRS 2, Share Based Payment, GN, guidance notice on accounting for share-based payments. 103 IFRS 3 Business Combinations AS 14 Accounting for Amalgamation. 104 IFRS 4 Insurance Contracts. 105 IFRS 5 Non-current assets held for sale and discontinued operations AS 24 and discontinuing operations. 106 IFRS 6 Exploration for and Evaluation of Mineral Resources GN 15 Guidance Notice on Accounting for Oil and Gas Products Producing Activities. 107 IFRS 7 Financial Instrument Disclosure. 108 IFRS 8 Operating Segments AS 17 Segment Reporting. 109 IFRS 9 Financial Instruments. 1010 IFRS 10 Consolidated Financial Statements AS 21 Consolidated Financial Statements. 111 IFRS 11 Joint Arrangements AS 27 Financial Reporting of Interests in Joint Ventures. 112 IFRS 12 Disclosure of Interest in Other Entities. 113 IFRS 13 Fair Value Measurements. 114 IFRS 14 Regulatory Deferral Accounts GN Accounting for Rate Regulated Activities. 115 IFRS 15 Revenue from Contracts with Customers AS 7 Construction Contract and AS 9 Revenue Recognition. 116 IFRS 16 Lease AS 19 Lease one and then IFRS 17 insurance contracts. First, IAS 1 presentation of financial statement, AS1 disclosure of accounting policies. 2 IAS 2 inventories, AS2 valuation of inventories. 7 IAS 7 statement of cash flow, AS3 cash flow statement. 8 IAS 8 accounting policies changes in accounting estimates and errors. AS 5 net profit or loss for the period prior period items and changes in accounting policies. 10 IAS 10 events after the reporting period. AS 4 contingencies and event occurring after the balance sheets. 12 IAS 12 Income Taxes AS 22 Accounting for Taxes on Income. 16 IAS 16 Property Plant and Equipment AS 10 Property Plant and Equipment. 19 IAS 19 Employee benefits AS 15 Employee benefits. 20 IAS 20 Accounting for government grants and disclosures of government assistance. AS 12 Accounting for government grants. 21 IAS 21 The effects of change in foreign exchange rate. AS 11 The effect of change in foreign exchange rate. 23 IAS 23 Borrowing costs AS 16 Borrowing costs. 24 IAS 24 Related party disclosures AS 18 Related party disclosures. 27 IAS 27 Separate financial statements. 28 IAS 28 Investment in associate and joint ventures. Accounting standard 23 Accounting for investment in associates in consolidated financial statements. 29 IAS 29 Financial reporting in hyperinflationary economies. 32 IAS 32 Financial instruments presentation. 33 IAS 33 earning per share. AS 20 earning per share. 34 IAS 34 interim financial reporting. AS 25 interim financial reporting. 36 IAS 36 impairment of assets. AS 28 impairment of assets. 37 IAS 37 provisions contingent liabilities and contingent asset. AS 29 provisions contingent liability and contingent asset. 38 IAS 38 intangible assets. AS 26 intangible assets. And 40 IAS 40 investment properties. AS 13 accounting for investments. And 41 IAS 41 agriculture. Roadmap for implementation of Indian accounting standards. A snapshot. For companies other than banks, NBFCs, and insurance companies, phase 1. First, April 2015 or thereafter, voluntary basis for any companies other than banks, NBFCs, and insurance companies and its holding subsidiaries, joint ventures, or associate companies. 1st April 2016, mandatory basis, companies listed in process of listing on stock exchange in India or outside India having net worth of rupees 500 crore or more, unlisted companies having net worth of rupees 500 crore or more, the parent, subsidiary, associate, and joint venture of above. Phase 2, 1st April 2017, mandatory basis, all companies which are listed in process of listing on stock exchanges in India or outside India are not covered in phase 1. Unlisted companies having net worth of INR 250 crore or more but less than 500 crore, and parent, subsidiary, associate, and JV joint venture of the above. Special point to consider: company listed on SME exchange are not required to apply in the AS. Such companies shall continue to apply existing AS unless they choose otherwise. Once NDAs are applicable, an entity shall be required to follow the NDAs for all the subsequent financial statement. That is, there is no looking back once the NDAs are adopted by companies. Companies not covered by the above roadmap shall continue to apply accounting standards notified in Companies Rule 2006. For non-banking financial companies, NBFCs, schedule commercial banks excluding RRB and insurer insurance companies and non-banking financial companies phase 1 from 1st April 2018 with comparatives. NBFCs having net worth INR rupees 500 crore or more, holding subsidiaries or joint venture and associate companies of above NBFC other than those already covered under corporate roadmap shall also apply for said date. Phases from 1st April 2019, NBFC whose equity and or debt security are listed or are in the process of listing or any stock exchange in India or outside India and having net worth less than 500 crores, NBFCs that are unlisted having net worth rupees 250 crore or more but less than 500 crores and holding subsidiary and joint venture and associate companies of above company other than those already covered under corporate roadmap shall also apply Ind AS from the said date. Applicable to both consolidated and individual financial statement, NBFCs having net worth below INR 250 crores and not covered under the above provisions shall continue to apply AS specified in Annexure to Companies Rule 2006. Adaptation of Ind AS is allowed only when required as per the roadmap. Voluntarily adaptation of Ind AS is not allowed. Scheduled commercial banks excluding RRB. Scheduled commercial bank excluding regional rural banks were initially required to implement Ind AS from 1st April 2018. However, RBI with a press release date 5th April 2018 deferred the implementation of Ind AS by 1 year, that is to be effected from 1st April 2019 instead of 1st April 2018. Further, the RBI thought a notification through a notification date dated 22 March 2019 deferred the Ind AS implementation till further notice. Urban cooperative banks and regional rural banks are not required to apply Ind AS. Insurance company MCA has had outlined the roadmap for implementation of Ind AS by insurer insurance company from 1st April 2018. IRDAI, Insurance Regulatory and Development Authority of India, deferred the implementation of Ind AS in the insurance sector in India for a period of 2 years, whereby the effective date was deferred to 1st April 2020. IRDAI with circular date 21st January 2020 has deferred the implementation of Ind AS in the insurance sector till further notice. Summary: the accounting standard aimed to improve the quality of financial reporting by promoting comparability, consistency, and transparency in the interest of users of financial statements. The ICAI has so far issued 29 years, however, as 6 and depreciation accounting was withdrawn on revision of Accounting Standard 10 property, plant, and equipment, and AS 8 on accounting for research and development has been withdrawn consequent to the issuance of Accounting Standard 26 on intangible assets. Thus, there are 27 IAS at present. In the scenario of globalization, India cannot isolate itself from the developments taking place worldwide. In India, so far as the ICI and the government authorities and various regulators such as SEBI and RBI are concerned, the aim has always been to comply with the IFRS to the extent possible with the objective of formulating sound financial reporting standards. In ASR, IFRS converged Indian standards issued by the central government of India under the supervision and control of ASP of ICAI and in consultation with NFRA. As per the MCA notification date 16th February 2015, Ind AS converged with IFRS shall be implemented on voluntarily basis from 1st April 2015 and mandatorily from 1st April 2016. Separate roadmaps have been prescribed for implementation of Ind AS in banking companies, insurance companies, and NBFCs.